Hi, everyone. Welcome to another episode of Coffee Talk with CastleHill. Today, we're actually going to be doing a roundtable panel with some friends of CastleHill who have graciously offered to provide some insights into today's climate, especially around how risk committees and board capabilities are changing and evolving over time and how they have evolved over time within the industry and within the overall risk management space. So I'm joined by Beth, Joe, and Yakut, and I'll ask each of you to maybe do a quick introduction. So Beth, if I could start with you.
Sure. Hi, everybody. My name is Beth Hughes, and I've had a diverse career in three of the world's big financial institutions, starting with Bank of America, also Bank of the West, which is part of BNP Paribas, and MUFG Union Bank. And my roles, I started as a commercial lender, so kind of the rock part of commercial banking. And from there also did IT, systems, data, and risk reporting leadership. I've been a change initiative leader, a risk manager and enterprise risk manager, and a risk governance executive. Most of this work, especially recently, revolved around supporting board needs around risk appetite, and risk governance. So especially being focused on the board risk committee and frequently at the intersection of board and regulatory requirements for risk management, including how to assess risk profile versus risk appetite, and the assessment and validation of how effective the risk management framework is operating. So I'm excited to be here for this conversation with my esteemed colleagues. And thanks to CastleHill for this great venue too.
Thank you, Beth. I appreciate it. Yakut, would you introduce yourself?
Yes, indeed. Thank you very much. My name is Yakut Akman. I have recently retired after putting in 40 years in financial services, mainly working for Citigroup for 35 years and the rest with Bankers Trust. That was then bought out by Deutsche Bank. A quick summary of my 40 years would be 20 years in operations and technology, 5 years in internal audit, and the rest of it in risk management. So I have really learned and practiced how the wheels turn behind the scenes and apply that knowledge to auditing folks and truly understanding the concepts of inherent risks, controls, and residual risk. And then apply all that knowledge to helping the company manage its risk much more effectively. My most recent position before I retired from Citigroup was as its Chief Third-Party Management Officer. We helped set up the overall policy standards and set up a whole new office to oversee third-party risk, which to this day continues to be an extremely important risk area, as I'm sure everybody would appreciate. But my responsibilities were global. So I had the opportunity to work with many different areas throughout the bank, and not to mention with other banks and regulators. Certainly had my share of interactions with the regulators, and learn from them, and understand the importance of managing regulators while managing our risk. Now I'm active still in the industry as an independent consultant. I'm on a couple of advisory boards and enjoy really still being a part of these types of conversations. So thank you again for inviting me.
Thank you, Yakut.
Sure, thanks, Tim. Hi, I'm Joe Iraci. I'm a university professor in risk management. I'm also a board member for the Risk Management Association. Prior to that, I was the chief risk officer of TD Ameritrade Incorporated, which is an online broker-dealer. It's one of the largest online broker-dealers in the United States. I've been in risk management roles for most of my career. Prior to TD Ameritrade, I held various risk management roles at Fidelity, as well as Deutsche Bank. I started my career actually, though, as a bank regulator coming out of undergraduate, and I was a bank examiner for approximately 6 years. From becoming a bank examiner, I was recruited into Bankers Trust, and that was my first foray into like, the more formal risk management structure at financial institutions. And I do think what helped me early on in my career is that I actually predated the naming of operational risk as a discipline. It was actually called business risk at the time. And my reporting line was through the business. So my first foray into risk management was where risk management had to show value added actually to the business unit it was supporting. And I do think that made quite an impression on me. Unlike many of my peers that I've worked with, though, I actually started my career after high school as a Marine, and I served as a Marine for 4 years before actually going to college. And I do want to thank Tim and the CastleHill team for this venue, which I think is a very important topic, because I do think that our risk management discipline is at a crossroads. And I do think that we'll begin now building toward providing additional value add to the firms that we serve.
Great points. And it was a fantastic segue, Joe. I really appreciate that because you talked about the beginnings of operational risk, and actually Beth is going to talk a little bit, I think, about the history and then also some of the, we'll go right up to the present, literally last week, about some of the new regulation or new guidance coming from the regulators.
Right, right. And so to bring a little history to it, but also a little interest maybe, I wanted to start, if you'll permit, with an anecdote, a little story about the history of risk management and regulation. Did you know that the first formalized risk management mechanism that is recorded in any rate was a rice futures exchange in Osaka, Japan, dating to 1697, which, risk nerds like me, that's pretty interesting. But perhaps even the more interesting part to me is that the government immediately regulated it. So you can see in that example just what we observe to this day, this dance between risk management, the development of technologies and tools to enhance risk management, and the government's, through regulation, the government's interest in making sure that those tools are robust and are supporting the public interest. So I'm going to fast forward quite a bit. I'll just briefly take a touch point at the financial crisis of 2007, 2008, because that generated a lot of regulation around risk management and the board's responsibilities for oversight of risk management for financial institutions. So that spurred CCAR, the OCC's heightened standards, and the Fed's enhanced prudential standards. So those are all kind of background, and those are very active, and they've been expanded upon since, of course. But just this past week, so we're going to jump from 1697 to February 26th, 2021, the Fed just issued something that is so on point to our topic today around risk committees, because it's entitled Guidance on Board of Directors Effectiveness. And anybody who is interested, you can find it on the Fed's website. It's SR 21-3 if you're really geeking out on this stuff. But it calls out the board risk committee specifically. And it's really focused on things that are not really new concept for boards' responsibilities around risk management, things like making sure that there's a linkage between risk appetite and your strategy, which I think Joe might touch on later. Oversight of the risk management framework and ensuring that the stature and independence of the risk management operation throughout the firm. But the other really notable thing about this new guidance is the Fed is saying, not only are we going to specifically assess the board, not just the bank, not just operations, but the board on their oversight responsibilities according to the criteria that are listed in the guidance. We are going to take the result of that Fed assessment and incorporate it directly into the Fed's rating for that bank. So here you're seeing this very, very intensive focus. And you can bet that if you're sitting on a board risk committee, you do not want the effectiveness or lack thereof of your committee to cause a downgrade by the Fed of your bank, right? So I think the significance is evident. And I think also that those of us who are or have been in the business of supporting board risk committees will also expect that the board risk committees will be looking to management to supply them with appropriate frameworks to self-assess and to ensure that the board committees are doing what the Fed is looking for, and that, you know, we can prove it. So a little bit of forecasting as to what some of the takeaways might be. But I also want to just quickly draw a parallel to non-financial industries, because I think even though this whole regulatory environment I was talking about was mainly focused on banks, I think it may be viewed as a harbinger and what some other regulated industries might be likely to expect in terms of their regulatory expectations for their own risk management frameworks. I'll leave it at that.
Thanks, Beth. Great opening. So Yakut, I know you mentioned you've been working with the board of directors, you know, for 30 or for a good segment of your career overall. And so, you know, how has that impacted some of those things? You know, seeing that the board is now going to be explicitly called out on the rating of a company, what would that do to you in your position of reporting information up to the board as well?
Thanks, Tim. As I was putting my thoughts together to prep for this discussion, I took a little bit of a journey that took me back a few years, and thought about, you know, what is really working, what's not working, and how do we get to where we are now. Now, I don't have an anecdote like Beth shared with us, but I did think about the history of how do we get here. And just based on my own experience, I think many years ago, when risk was a dirty four-letter word, and it was mainly discussed in the context of financial risk, market risk, or credit risk, it typically meant trouble and losses and write-offs and what have you. And later on, a number of really smart people, certainly in the insurance and the financial services industries, came together, and operational risk was born as a separate discipline. I think, this is my personal opinion, operational risk really made people, and certainly starting with the boards, realize that risk was no longer a topic to be discussed in the context of various business discussions, but there was a lot more to risk than what was experienced before. And certainly with formally identifying operational risk as a separate discipline, and they needed to allocate more capital, define risk appetite differently, you know, find ways to measure operational risk, and so on and so forth. Now, it's not my intention to really have an in-depth discussion on the evolution of operational risk. But I would argue that really with operational risk and the expansion of the risk, the scope of risk, that really gave birth to risk committees having a seat at the table, so to speak, at the board level. Now, I don't know the exact date of the birth of the risk committees, and I think Beth would be the right historian to tell us about that maybe later on. But you know, several years ago, there were no risk committees. As a matter of fact, to this day, some companies, some boards do not have a separate risk committee. Many a times, the audit committee sort of assumes that responsibility, and or a lot of the boards will have an audit and risk committee. The arguments against having a separate risk committee would be risk is an risk oversight is an overall board responsibility anyway, excuse me. Various board committees naturally address risk through their respective chartered activities. Now, to me, that's short-sighted. There is really a growing need to have a separate risk committee so that the boards can properly fulfill their corporate governance oversight responsibilities. And the skills needed for risk committees differ from those that would be typically assumed by an audit committee. But here is the really important point that I wanted to really raise. Based on my experience in dealing with our boards, our audit committees, risk committees, even though the tone is set at the top, and it is so important that the board sets the tone, and then the CEO, and then the executive management, and the senior management, so on and so forth, it's really a circular process because the information that is provided to the board really comes from the bottom up. And it's been my experience that sometimes if there is not a full understanding and appreciation of risk and risk management at the lower levels, then the boards do not necessarily get a complete picture or even a correct picture of what's happening at the lower levels or throughout the company in terms of their risks. So it is so important that risk is properly appreciated at every level, and the company policies and standards are clearly communicated and understood and owned by management and trickling down from them to the more junior levels. And risk is considered to be the responsibility, is not considered, sorry, the responsibility of a detached risk management department. And that's another, to me, a problem that I see in many companies. Many business managers will say, yeah, I have a risk management department, they take care of my risk. If management really does not understand and does not spend the time, then they're bound to have lots of problems, make errors in their strategies, in their business plans, and in understanding and monitoring risk. So it's, as I said, it really is a circular process. It has to be a part of the overall culture. Otherwise, no matter how talented and skilled and experienced your risk committee is, they're not going to be fulfilling their governance responsibilities as expected. So I'll stop there.
Thanks, Yakut. I mean, you've talked a lot of, you've implied, I'll say, a lot about that horizontal view that needs to be there. Joe, you want to talk a little bit about maybe more of that horizontal view, maybe as part of your introductory remarks?
Sure. And like what I'd like to do is ultimately like talk about the concept of enterprise risk management, Tim. But first, I do like that Beth had brought in about the Osaka exchange because it shows like the evolution. But if you look at risk management, the oldest risk discipline is obviously credit risk. Credit risk is a bedrock foundational risk that all financial services has, and it's existed in financial services for centuries. But if you look at what happened in the 1970s, remember, we had the concept of stagflation, where you had inflation rising, economic growth declining. We're talking about interest rates right now of going up, and they're at 1.5% for the US 10-year Treasury, where if you remember in 1978, the prime rate in the United States was actually 20%. And there was also what was called disintermediation. So you had credit risk, but you had such a volatile operating environment, it also begged the question about better asset liability management. Now, what allowed banks and financial institutions to deploy better asset liability management models is the IBM PC, as well as the first Apple that was introduced around like the 1979 to 1983 timeframe. That allowed then the development of liquidity risk models, especially because of the volatile operating environment as it pertained to disintermediation, as well as interest rate volatility. And then as time went on, you started having new instruments coming into play, such as interest rate derivatives, credit default swaps, and securitizations. And these new products starting to drive the need for market risk management. And through the 1990s, VAR became the primary tool for market risk management, eclipsing the other methodologies that were out there at the time. But even with these developments in market and credit risk, what did we also see during this time? We also saw reputation risk and headline risk, which that starts to get the board concerned, right? And so we had better models for market and credit, but things like Enron still happened, which was operational risk. Barings Bank happened, that was operational risk. We had write-offs where traders were mismarking their positions, that's operational risk. So what grew out of that need then is the concept of operational risk, starting really with the original Basel Accord and going through the successive Basel Accords, and then you had the formation of operational risk. What's interesting though about operational risk is operational risk then started to take risk management from a heavily quantitative driven model to where all of a sudden risk management and business management started to intersect. And I think people have to have that understanding and appreciation of operational risk, because like to me, when I think of operational risk, that's where business management and risk management actually intersect. Because market and credit are based on homogeneous types of risk, whereas operational risk is how the business actually operates itself. And until we get to the point where we further develop and mature operational risk, we run the risk of continuing to have those headline risks, because a lot of the headlines are actually pointing to control breakdowns of operational risk. Now that during all of this time, there's different needs that influence both management and the boards. What you need to operate in a credit environment is different than what you need in an operational risk environment. That difference then starts to drive the selection of your board members, because it starts to look at your risk profile. Now what we're looking at is the evolution of risk management again into this concept of enterprise risk management. But if you look at the definition of market, credit, and operational risk, they're managing the risk of something. But if you look at the definition of enterprise risk management, the definition actually says it's a process, and the process is intended to align risk management with corporate strategy. So the ERM function, by its nature, actually faces off to the governance structures, including the board. But what it should do is tie into the market, credit, and operational risk management teams to make sure that information flows throughout the organization, is compiled, and actually is provided to the right level of management for decision making, but also to the board. So the influence of ERM starts to drive the way risk management is done within institutions, but it is also starting to drive what information goes to the board. And depending on a firm's business model, it starts to influence what's the makeup of the board, as well as what coverage the board has over the risk management function. And I think going forward, ERM not only will play a larger role in corporate strategy, as well as traditional governance, but it will also take on a larger role in determining risk culture and firm-wide culture. Because at the core of successful firms is a positive corporate culture. And if you get culture right, decision-making starts to be made from value-driven decision-making off of the tone from the top. And I think ERM plays a critical role, as does the other risk disciplines.
Oh, it's great points, Joe. So I think one of the pieces that all of you have brought up is really this aspect of there's a conflict, somewhat of an inherent conflict that's happening between the activity of actually driving your business and the oversight and governance function that needs to be there at a top level in the organization. And the ability for, or and certainly disagree with the thesis, those top level organizational models, right? They need the risk committee to be those people empowered with the right information to provide them the visibility and transparency into what's happening out in those different areas, right? From the commodity exchange in Osaka, right through all of the different cycles that we've been through and all those pieces. And so with things like the regulation that's just come out from the Fed and other areas of that sort, how do you think those risk committees are going to have to go towards the future? Right? What are we going to have to do from a risk committee perspective? Is it more horizontal focus? Is it more quantitative focus? Where do you think it's going to go?
let me answer that question with also picking up on something that Joe said, which I found very interesting, and I agree with his point. As he pointed out, when we talk about credit risk, which is the oldest risk or market risk, these are homogeneous risks, and it's not that difficult to find good, skilled, experienced people who may eventually get to a board level. When we talk about operational risk, and that's where the regulators are really spending more and more time, it's the gift that keeps on giving. You know, we have new types of risks that now fall under operational risk, whether it's cyber risk, third-party risk, and lots of other risks that just keep on creeping up. So it is very difficult to find people with that kind of a multidimensional, colorful background who are knowledgeable enough, not in various business areas, but also in understanding and managing risk, who they can get to a board level and provide that oversight regarding whatever the company is doing, because these things continue to grow in size and scope and complexity. So the boards really need to pay attention to the makeup of the members of the board, and particularly the members of the risk committee. And that's a challenge. I don't really have an answer, but I think throughout the industry, certainly the highly regulated industries, as risk becomes a more and more important area, we're seeing an increase in demand for good, quality people, and the demand is still, I think, outpacing the supply, both in terms of quantity and equally important quality of these folks.
I think the boards have to have an appreciation, not just for quantitative modeling. The boards have to have an appreciation for qualitative analysis as well. Like if you look at the current pandemic that we're a little over a year into right now, started as a health and safety event. So it was a pure operational risk. And then from that operational risk, the first thing that happened was fear about economic growth in China. That led, because China is such a linchpin, especially for global manufacturing, Chinese growth concerns automatically turned into economic growth concerns. And what did we see? We saw an acid correction across the globe, with the S&P 500 as an example dropping 35%. From that market risk concern, then, there was concern around credit and liquidity. So you had unprecedented financial and fiscal and monetary stimulus that occurred across the globe. That then protracted out concerns around credit, because the banks didn't actually the banks did not start taking provisions to replenish their loan loss reserves until really 5 or 6 months, down the road, when they actually started replenishing reserves. But my point on this is, if you look at a list of most emerging risks, pandemics actually would have been on there, but yet nobody actually flagged that the pandemic was going to occur, and we lost 3 to 5 months of planning across the globe. And I think going forward, there has to be an appreciation for this concept of emerging risk and qualitative analysis, especially at the board level, because the board has to set strategy. The strategy is what we want to accomplish. Execution is done by management. That execution is how it's done. But in order to align all resources, it has to start with strategy. So I know that was a long-winded explanation, but I think part of this is pointing to the qualitative analysis that's needed to try to determine directionally where firms need to go. And I do think we have a lot on the line right now, because as an example, if you look at the original listing of the Fortune 500 companies going back to the 1950s, you know that 2/3 of them are out of business? And they're out of business because they could not take advantage of potential changes in the marketplace to keep their companies actually competitive. And the stakes are actually higher now because the velocity of change is occurring at a faster rate.
I just want to pick up on that, Joe. I think you did a really great job of connecting between enterprise risk management that's looking at the interrelationship of how it's rarely nowadays a single risk, right? it's a snowball effect or a domino effect, starting with one event that was thought to be a health and safety and becoming a global economic event. But also another example of that would be the recent climate-related risk management incidents. So both in California and in Texas, where for different reasons there were energy shutdowns because of climate-related events. So this is just to follow up on your thread, Joe, of the importance of emerging risk. It's impossible to have a crystal ball where you can predict what's going to happen. But I think the point is that increasingly risk committees are going to need to source board members who have facility in thinking very broadly about potential black swans, et cetera, and think creatively about the risk environment with a grounding in the actual business that they're overseeing as board members, and preparing for those kinds of, even though they may not be fully anticipatable, you can have your list of, possibles and what are we going to do if this happens. It's scenario planning is what it is. And so that's a really essential part, I think, of the toolkit for risk management going forward, to be able to integrate all of the risk management disciplines holistically.
Beth, that's such a good point. I couldn't help myself but interject, because I totally agree with all the points you made, but I was thinking to myself, but for a board to react the way you defined, then the companies, certainly the board, has to have that mentality as well.
Absolutely.
Joe, to your point, and maybe that's why a lot of companies fail to exist, because they thought they could manage the old-fashioned way, and they didn't really have that foresight. They didn't connect the dots, no matter how obvious they were, even right in front of their faces. So there are lots of lessons learned. It's always good to study history, right? It may not necessarily tell us what's going to happen in the future, but it'll help us avoid the mistakes of the past. So anyway, I wanted to just comment on the fact that there's just one more step to make sure that the company really appreciates what it is that they need to have as part of their strategy.
Right. And I think, to pick up on your point and also connect it with something that Joe was talking about earlier, the nirvana for a risk committee and the risk culture of the organization is really the point where you're thinking creatively enough with the right quantitative framework underneath to be able to identify not only the risks, but the opportunities, because as you said, you can't make money without taking risk. So which risks do we want to take? What are the right risks? How can we actually drive our business forward with a really risk-aware view that will help us make the right choices and be more profitable and be more successful? And I think what we're all saying is, in an environment like this, there's no way you can be an effective business without risk management disciplines being part of the toolkit.
Yeah, to try to equate that, Beth, to a sports analogy, I think boards and risk management have to be flexible enough to know when to move from defense to offense, and actually when to move from offense and defense. And I think the stakes are increasing, because there are so many changes in the marketplace and they're happening so much more rapidly. But as I said earlier, change does not have to be negative. Change could actually point to a business opportunity. It has to be analyzed, and then there's a decision that has to be made. And I think at the core of planning, the planning process itself is about decision making.
Building on that, from defense to offense, I would say certainly at the board level, how do they get to a point so that they manage risk or oversee businesses' risk from reacting to problems and looking for solutions to proactively really staying one step ahead of the game and say, hey, we really need to, for instance, look at climate change, what the impact may be on our organization. What do we need to do about it? Be realistic about our next strategy plan and what have you, versus, oh my God, we have subsidiaries in California, Texas, and now because of all these horrible events, now we need to spend money and manage the risk, blah, blah, blah. And we're constantly one step behind. We're constantly playing defense, as you said, Joe, or reacting to events, reacting to risk events. And hopefully we're learning from all this. We're going to go into a more taking an offensive position or being much more proactive. Not that it's easy, but that's where we need to get to, right?
Right. And Beth had brought up scenario analysis as a tool. And I think scenario analysis is one of the tools that could actually help a firm to toggle between defense to offense. Because if you look at a traditional stress test, a stress test is usually built off of 2 or 3 risk factors that are very heavily focused on market data, right? Now, when you move from a stress test to a scenario analysis, the number of risk factors increases exponentially, because then with a scenario analysis, you could start pulling in operational risk, emerging risk, strategic risk, and then you could actually run through scenarios to where you bring business management in and you do things like desktop walkthroughs. How does a firm react to certain things that change in the marketplace? And I think the beauty of ERM and the potential of ERM, it's to help boards and management in this area of emerging risk and strategic risk, because they're not built off of quantitative models. They're actually a qualitative analysis. And it's actually the emerging and strategic risk that what we've seen in the past are usually what get firms in trouble or point to why firms actually succeed. Because they have identified potential marketplace changes and were able to capitalize on the change. Remember, BlackBerry basically invented the smartphone, but they're nowhere near the top now. And not to pick on BlackBerry, but there's numerous examples of firms who were leading edge firms that simply did not make the changes off of the marketplace changes, the internal changes to the firm off of the marketplace changes. And I think that's the responsibility of boards, because boards have to set strategy and direction. Management has to determine resources and allocation and execution.
This really argues for a very strategic makeup in terms of what we're looking for board risk committee membership. So that's one thing, but I also have a pretty strong view about the importance of management's responsibilities, because I think management it's their burden and their privilege to be bringing to the board what they see in terms of the threats and opportunities, and making sure that they're providing the board with as much good input as possible so that the board can make the right strategic decisions. So in all this discussion about the risk committee, I'm really aware of how important management and the view from the line can be in making sure that the board is successful.
And I will take it one step further, Beth. It is so important that management really has their tentacle, so to speak, their pulse on what's truly happening in their companies. I have seen managers who delegate the responsibilities and just let me know how things are going on, certainly in the area of risk, because risk is not a sexy topic. It costs money, I'll just have somebody else do it. So to the point that I made earlier on, what flows to the board certainly goes through management, several layers of management, senior management, and then to the board. And there could be some levels that jump ahead and provide the reports and may even present it to the board. But if there are gaps between at the senior levels, what they know, what they're interested in knowing, or the overall culture being a culture of fear, if the information is not flowing, or there's not a good appreciation of what's truly at risk, the boards, whether it's a risk committee or any committee at the board, will not get a complete picture. And that's why it's so important that the boards somehow know about the makeup of the management. They certainly handpick the CEO, but they make sure that they have the right educational programs, the right communication, the right campaigns and whatever that they promote, make sure that they have a good flow of information going horizontal, vertical, every which way. Otherwise, the boards will be at a disadvantage as they set the strategy and make decisions because they will not have the full set of data and the full picture.
Can I key off of that, Yakut, because then we're running towards the end of time. So Joe and Beth. So Yakut, you started talking a little bit about what the, if you had the magic wand, what would your board or risk committee know or be able to see? So Joe and Beth, what would you do with that same kind of a scenario? What is the thing that you would insist that those risk committees and board teams know?
I would say the board should be aware of business as it exists today. But I think the real value of the board, because you're bringing in accomplished professionals to sit on the board. I think the real value of the board is getting the firm set up for the future. And I kind of look at risk management as risk management may use historical data, but risk management should always be forward looking. And that's where I think the value of the board really could help firms is, you bring accomplished professionals in, they should help determine the future to where it's not this a nebulous crystal ball. You could get a little more analysis and then help set direction. So I think it's to help firms be forward looking.
I would agree with that. And I think an extension of that is also to bring to the board of this particular company a broader world perspective. It's very easy when you're focused on your own institution to get a little bit insular in your view. So I think one of the benefits of the board is bringing multiple industries and disciplines and that very holistic environment to the view of managing or providing the strategy rather for managing the firm.
I will agree with both of my colleagues. Nothing more to add. They said it all. Thank you.
Great. Well, I really appreciate you all joining me today, and it was a great conversation. And hopefully, we'll be able to do it again, either as this group or even broader group. So, thank you again, Beth, Yakut, and Joe. Have a great day.